Hi everybody, welcome to another update on Stock Screener. Today we're going to talk about Pieridae energy. This is a new gem that I found, and I'm going to sell some of my Sigma lithium to buy this. So this is a pretty good play, a multi-bagger. So what is this company? This company produces natural gas, 80%, and some oil in Alberta, Canada. So we need to look at the AECO price. So as you know, we have the Henry Hub price, which is this one, and it's currently at $6. And the AECO price is currently around here, $3 to $4. So I expect that this arbitrage will also close between AECO and Henry Hub at some point, and this could benefit Pieridae energy. You can see here what the current price is of AECO at 3 to 4 Canadian. So very low prices compared to Henry Hub. And here this is from the previous month. It was even at $1, very cheap, and has come back to the $4 range. The futures market tells us that we should be going to the $6 level, 5 to 6, in the winter, because people will be heating more. Then it comes back down in the summer, but it will stay around $4. So keep that in mind. This is the long-term price, $4. Okay, so let's look at the technical analysis first. So this is a pretty big resistance, around 0.86. I think it will bounce at this level. So we are at the bottom probably, and will bounce and go higher in the next few years. Valuation wise, we are at a market cap of 150 million CAD. It has quite a lot of debt. So this is the liability 500. You can see that here. And that is around, around 200 million debt and some other obligations. So pretty high debt. And that is actually the thesis. As they pay off the debt, then the price of this stock will go up, because they don't need to pay the interest anymore on that debt. So that's the thesis. Price to book is pretty high. So the equity is only at 1 million, so that's very low. Well, currently it probably is already at 20 million equity because they earn some money. But this will gradually rise, and rise very fast, because the PE ratio is only 2 right now. So there is undervaluation in this company at a PE of 2. Enterprise value is very high at 400 because of the debt. So enterprise value to free cash flow is around 3, and EV to EBITDA is around 2. EBITDA is around 200 million, so very high compared to the market cap. They still have some cash over. Earnings are about 80 million CAD, probably going to 100 million next year. And that's the free cash flow, 140 million. Shares outstanding, 160 million. They have reserves, probably a mine life of 15 years. So that's high reserves. And low decline rate, very important, only 8% decline rate. That's good because that means that the capex will be lower. It's around 50 million. If you compare this with the EBITDA, 200 million, then it's less than half of the EBITDA. So that's very low capex. That's good. So let's go on here. AECO I will talk about later. Production as well. So what do they own? They own these assets here in Alberta. They own 4 assets here. You can see them here. It's very small, but you can go to the presentation. They own 4 properties in Alberta. Production has been declining a bit. They had some issues with production, maintenance, plant maintenance, but that will go back up next year. So now let's talk a bit about the pricing of AECO. We already know that it will be around 4. Here you can see that it had a nice dip. Well, actually not nice, but it went to $1. And the reason for this is because of maintenance of the pipelines. So Alberta, that's Alberta here, and we are at the foothills here. And the operator of the pipelines is the NGTL, TC Energy. And as they do maintenance, then gas cannot flow anymore. So that's why the prices are dropping. And maintenance has been done and now it's back up. But this is the issue currently, why AECO prices are actually down compared to Henry Hub. Now, in the past, these prices were always the same, Alberta and Henry Hub, but it's only right now that there is an arbitrage between these two. I think that this arbitrage will resolve itself at some point. TC Energy is now doing some expansions on the pipelines. And one of the major expansions is the NGTL system expansion, which is this thing here. They already did some expansions here, 1, 2, 3, 4. So this is 1, 2, 3, and 4. And now they're doing the 5, which is going to be completed next year in Q3. So that's this pipeline here. So that will alleviate some of the issues and we will get a more stable AECO price. So that's one catalyst for the price of natural gas. So let's talk about the earnings. So production is around 36,000 barrel oil equivalents per day, and per year it's this here. They are going to add another 2,600 next year, so that's about maybe a 5 to 10% increase. I think that they can keep increasing this 5 to 10% per year. The revenue for the second quarter was around 41.8 per barrel, and that was at a price of 4.67. So keep that in mind. The price that they got was 4.67 in the second quarter with this revenue 41.87. So that gives us a net back of 16.9. That's this number. And with these two numbers, we can calculate the AISC. So this is the cost per barrel of oil equivalent. This number we are going to use. Okay. Also important, they have hedges currently. And the hedges are currently at below $3. The AECO price is now already at 4, maybe going to $5. So as these hedges come off, and you can see that here, 45% is hedged. Next quarter, only 20%, and then 7% next year. So as these hedges come off, we will see the realized price go to the current AECO price, which is $4. So that's a positive catalyst for the pricing of the revenue. Okay, so now the valuation. This is a very complex formula. I will explain it. So we always use the technique production times price minus cost with a 5 multiple. So what is the production? It's B21. Talked about that. The revenue price. What's the price? This is the price. And it's using the $3 AECO price at the current moment. Minus 16% of the price minus 4.67. And the 4.67 comes from here. That was the realized price. This 16% is the royalty. So royalty is around 16% when you look at this number here, 7 of 41. So I subtracted the royalty from that, from the incremental change compared to the natural gas price in Q2. As the price goes up, then we will have a lower revenue because the royalty will be going up. So that's just this change. And then we have here the price of the natural gas, which is this number times a conversion factor. And that conversion factor is using these numbers here, 41.8 and 4.67. So if we take the price 4.67, then these will cancel each other out. And then we have 41.87 as the price of this equation. So the price times the production. Now this here is the cost. So price minus cost. And the cost is this AISC, 24.97, which was derived from the revenue minus netback. So that's the equation with a 5 multiple. And we get a valuation of 146. So that's somewhere here at $3 AECO. And we know that currently the price is at $3, okay? But I expect this to go back to the $4, $5 range. That's why I put $4 here. And as you can see, when we go to $4, then valuations get much better. So let's say we go to $5, which is possible. Then the valuations will probably get even better. So if we go from 3, 4 to 5, which is possible because the outlook says that we are going to 5, even to 6 by next year, January, then we already see that we could go from a 150 market cap to 150 market cap. So 1.5 billion from 150 million. So that's a tenfold if we get a good AECO gas price. Of course, it won't stay at 5. It will come back to the 4 level. So I think the equilibrium will be somewhere here. let's say at 500. 500 is still better than 150. So there's a double, a triple possible at the equilibrium price of $4. Now, our thesis. Let's say that the price goes to $5. Then they could easily pay off a lot of debt, right? And as they pay off the debt, then the interest payments will come down. And I will illustrate this on the balance sheet here. Currently, we have 13 million in interest payments. That's a lot. And where does this 13 million come from? It comes from 20% effective interest rate. Very high interest rate. And this 20 million on the long-term debt. Current portion is 30 million. So if you take 20% of that, it's around 7 million. And then add some other costs to it. So you get the 12 to 13 million, okay? Now compare this 13 million to the net income, which is 23 million. So it's almost half of this. It's more than half of the net income. So if they are able to delete all the debts, pay off all the debts, then you could see net income grow by 50%, right? So this is part of the thesis. By paying off the debt, the net income could rise another 50%. So that means that the market cap will rise by 50% if they pay off all the debt. And the PE is now already at 2, so it will probably go to a PE of 1.5. So the valuations will get cheaper over time as they pay off the debt. Okay. And next year they can even refinance it. So the interest payments will go down over time as they refinance that debt. So that's the play here. Currently they have a lot of earnings coming in, 80 million, can easily pay off the debt quarterly, and in the future interest payments will come down and the earnings will keep on rising. As the hedges come off, also the revenue will rise. And the AECO pricing will be more stable by next year as well because of the expansion of the NGTL. Okay. So here you can also see that they have 3 new wells coming online by next year. That's the 2,600 I was talking about. And as a cherry on the pie, we also have the LNG project that they are working on, but this is very long term, 5 years out. They could start building this LNG project and transport all of this gas to the East Coast and ship it to Europe. So that's the long-term plan, but I'm not taking that into account yet. So let's just focus on the repayment of the debt and on higher prices. So we need to check the AECO price daily to make sure that this stays above 3. That's very important. This company has a lot of debt. We do not want the price to go below 3. Otherwise, it will go bankrupt. So at 4, I'm happy. If it stays at 4, plenty of upside over time as they pay off the debt. If it goes to, let's say, 2.5, what would happen then? Then we have negative cash flow. So we do not want to see it go to 2.5. 2.7 is probably, yeah, around the break even. So 2.8 is break even. And that's why they also hedged their production at 2.6, 2.8, because that's the break even price. So let's hope, yes, it's hope that the AECO price will stay at $4. I'm pretty sure that it will stay at this level. Here as well, you can see it's pretty stable at $4. So that's a prerequisite for this thesis. But you can see the upside. If it goes to 6 AECO, then this can be more than a 10 bagger over time. So this is a very leveraged play on the natural gas price in Canada. So I'm buying a sizable position and we'll see where it goes. And I'll see you in the next video. Bye.